Please welcome your panelists for Financial Regulation, New Era, New Regulators, moderated by Politico Chief Economic Correspondent Ben White.
Round of applause for our panelists. I think that's my cue to start talking. Thank you for joining us for this financial regulations panel. I'm reassuring my panelists that more people will filter in, but I did see Tyler Perry in the ready room and Dr. Oz in the ready room, so it's stiff competition at Milken, but we'll have a good session on some really important topics that a lot of people here care about in the world of financial regulation. I'll just introduce you to my panelists. First, we got Michael Piowar, who's a commissioner at the Securities and Exchange Commission. Craig Phillips is counselor to Treasury Secretary Steven Mnuchin. Jeb Hensarling, of course, is the chairman of the House Financial Services Committee. We've got Chris Giancarlo, who's chair of the CFTC. And we have Ju-Young Lee, who's a managing director and head of North American Financial Institutions at Fitch. So I thought we'd start with some level setting and start with Craig to talk about where we are in the administration's efforts to change the financial regulatory landscape. There was an executive order at the beginning of the administration, a series of reports from Treasury on various aspects of financial regulation in capital markets. We've got another one coming out soon about FinTech, and we'll ask him about that later. But tell us where we are in your estimation on what the administration wants to do in the financial regulatory space and what remains to be done.
Well, thank you. The president, I think, did a great thing by laying out the core principles. So what we addressed in the executive order was critiquing the current regulatory and legislative environment relative to the core principles, which are things like giving consumers more choices, the effective tailoring, efficiency of regulation, accountability of regulators, making our institutions competitive globally, and also protecting taxpayers. So this suite was the prism through which we looked at the system, and have really published on the banks and credit unions, capital markets, and asset management insurance. The president also asked us to reconsider orderly liquidation authority and the FSOC designation process in 2 presidential memorandum that we've now published on. And Ben, as you know, we're going to really put out an important final piece on innovation, FinTech, and the future of the financial system. So I really think the framework are the large toggles or levers that we have are really capital and liquidity in the system, how efficiently our markets operate, and a series of sort of rules that relate to products and sort of access to products that permeate the system. And the overarching conclusions are that there can be a very significant amount of tailoring and recalibration of regulation while still preserving the basic gains from the crisis. Many of those gains are things such as resolution planning, stress testing, and liquidity management, among others. But the essence of our conclusions is that what's appropriate for the largest institutions is not appropriate for regional banks and community banks. The banking bill, and the House is working on a counterpart, does a lot of movement on that. There's more to do on the regulatory side. It's too hard to get a loan. The process of getting loans, access to credit, has been negatively impacted by these regulations, and we've made a lot of recommendations on that front. And Director Mulvaney is addressing many of them at the CFPB. And finally, the liquidity of our markets, access to capital, the ability of companies to go public and stay public, how derivatives are exchanged, how ETFs work. These are building blocks of sort of investment and sort of building wealth for institutions and for individuals, and we made a lot of recommendations on that front. So in total, we have about several hundred recommendations. About 2/3 of them can be done through the regulators, a slightly higher percentage for the market-related ones, and 25 or 30% require the act of Congress to amend Dodd-Frank and other statutes that need to be modified.
And let me just follow up on the Senate banking bill for a second. Of that 25 or 30% that require legislation, how much does the CRAPO bill, the Senate banking bill, of that get that done? Is that enough on the legislative front? I know we'll talk to Chairman Hensarling about some of his desires for additions and where that stands, but are you satisfied? Obviously, the administration supports that bill and wants to see it get through. How much of your goals does that accomplish?
I'd say it's a start. There's a lot more to do.
Okay. Could you give us like 1 or 2 specifics of things that it doesn't do that you wish it did do?
Well, a lot of it's in the nuances, the details. So if you take a basic provision like the Volcker rule, it's a very prescribed process that was defined in the legislation. So while the regulators can do some adjustments, and we have full 5 rule writers, and I agree with Jeb that reducing that to 1 would really help, that really the process of clarifying how Volcker impacts the market does require some legislative change along with regulatory change. So really it's really in the nuances of things that aren't either all or one, and that's where the nuance in this bipartisan compromise just really wasn't there. So there's things on the list, but there really was not what I'd call adjustment in really critical pieces of Dodd-Frank.
Okay. All right, Mr. Chairman, I want to assess what some people think has sort of been a shift in your position towards the Senate banking bill. There was, at first, a lot of opposition on the House side from yourself and some other conservatives on the House side saying, look, this thing just doesn't go far enough. It ignores a lot of bills we passed with bipartisan support, and we are going to change it, and we want a conference and all of that. You made remarks, I think, at the American Bankers Association that suggested that, okay, you're okay with the Senate bill getting through the House as it is, going to President Trump for his signature, and then perhaps coming back with a new vehicle to pursue some of the other things that you would like to happen. Is that a correct perception? Are you now supportive of the Senate bill as it's written, passing the House, being sent to President Trump for his signature?
Not quite so. So the original marker I laid down was not that I necessarily objected to the Senate bill going forward. What I objected to was rubber stamping a bill without any negotiations between the House and the Senate. So I've had an opportunity to speak now to a number of senators on the subject, and then as the Wall Street Journal opined not all that long ago, the House is not a potted plant. You mentioned conservatives. Yes, I am a conservative, but the bills that we are trying to get done are not necessarily conservative bills. They are strongly bipartisan bills. And so I do want to give credit where credit is due to my Senate counterpart, Chairman Crapo. I wasn't quite sure the Senate was capable of anything. So we're very happy they produced a bill.
Shameless Senate bashing going on here.
Well, you know, you got to have a little fun in your job, so I'm having a little bit of fun here. No, but in all due seriousness, it was a good piece of work. It is fundamentally a sound community financial institution regulatory relief package. There does some good for our regional banks, but at the end of the day, roughly 80% of banking assets are left untouched, and it has a very modest capital formation title within the bill. And we know that roughly 80% of corporate debt comes from our capital markets. And so again, relative to history, this will be probably one of the strongest pro-growth deregulation bills that comes out of Congress in easily a decade, if not more. Relative to moving the dial on GDP growth, it's got a ways to go. So that would be my first point. And so I do believe we now have a 3% growth tax policy, but I do not believe we have a 3% growth regulatory policy, especially when it comes to banking and capital markets. I'm not saying that the roughly 36 bipartisan bills that we have in the House get us there, but it at least helps move the needle some. And we have 12 bills that passed unanimously. And so what I've told the Senate, and as I've met with both Republican and Democrat senators, we need a pathway for this. Efficiency would say that we put it into S-2155. If the politics doesn't work, fine, give us another avenue, or give us another venue, or give us another pathway to get these bills done. So I'm at least encouraged by those talks. I'm not indifferent as to the timing of when we get 2155 done. I hope it is a matter of being in the fairly near future, but I still want to make sure that we have a pathway to get these other bills from the House taken care of.
Okay, so if I can just understand what you're saying basically is once you're given that pathway, once you're given some guidance on how these other bills can find their way into law, then you can move forward with 2155 as it is.
Yeah, as I indicated to the Chamber of Commerce, where I spoke, happy to attend multiple signing ceremonies in the White House.
Okay.
You know, you get a collection of pins. I got 2 teenagers. They like the pins. So, yes, I'm more than happy to go to multiple signing ceremonies.
Gotcha. Okay. Chris, and I got lots more questions for you, Mr. Chairman, but we'll get everybody involved here. Chris, let's talk a little bit about the CFTC and where you've come under the Trump administration so far in terms of regulation in your space and where you see it going forward, what you are going to work on next. Give us a little bit of the overview of the commodity space, the CFTC space, on what's been done and what you're working on.
Yeah, so it's interesting that the conference this year at Milken is navigating a world in transition. In a lot of ways, I see myself very much as a transitional chairman of the CFTC. And by transitional, it's both a backward-looking approach to assess what worked in the implementation of Dodd-Frank in its reform of the over-the-counter swaps market, derivative market, and what has worked in some ways extraordinarily, leading to second and third order magnitude issues, such as the supersizing of global clearinghouses. What has worked less well, such as the swaps execution implementation by the CFTC, which has fragmented global liquidity and actually caused a greater liquidity risk in the marketplace. And what do we need to do going forward? As comprehensive as Dodd-Frank was, it didn't address cyber. It didn't address the digitization of markets. It didn't address the use of a lot of new technology, artificial intelligence, machine learning, et cetera, in the markets. And so we need to both deal with the issues of the past that are incomplete or suboptimal and issues of the future. And to that end, just last week, our chief economist and I published a white paper, which we call Swaps Regulation version 2.0, that looks at the first crack at swaps reform that was done mostly between 2012 and 2014 by the CFTC, and says, how can we now take the next level of implementation in a way that both protects the systemic stability issues that were addressed, but also how do we do it in a way that we have a market vibrancy and a market health that hasn't been there. So it's a combination of systemic stability and robustness and health of markets and attempting to address the fragmentation of markets.
Okay. Ju Young, I don't want you to go last. The reason I'm going to the others first is I want you to react to what all these people say. So I'm going to get the regulators, and then you can tell me everything that they're doing wrong and why we should be afraid of a lot of this regulation. So that's the only reason that I'm going in this order. So I want to go to you, Michael, and talk about the SEC. And interestingly, you were there the Obama administration, and you're now there in the Trump administration. So you've straddled two very different approaches to securities industry regulation. Talk to me a little bit about kind of what the difference is and how the agency has changed from the Obama point of view to the Trump point of view.
Yeah, so like Chris, I see an obvious parallel navigating a world in transition to navigating an agency in transition. So 15 months ago, I was fortunate enough to be designated as acting chairman of the SEC while our new chairman was going through the confirmation process. And prior to the changeover administration, for 6.5 years, the work of the SEC could have been summed up in 2 words, Dodd-Frank. We had 100 mandates from the Dodd-Frank Act. Most people think when the Dodd-Frank Act was passed in July of 2010, that was the end of the conversation. It was just the beginning. Told the regulators promulgate about 400 new rules. We were responsible for about 100 of them. We got about 80% of the way done. With the changeover in the administration, I took the opportunity to say, look, we're going to take a pause on our Dodd-Frank rulemaking for a couple of reasons. One, because Congress, and Chairman Hensarling in particular, was putting forth some proposals that would either repeal some of the provisions in Dodd-Frank or change some of the provisions. And someone being in charge of an agency with limited resources, the last thing I wanted to do was waste our resources on something that was either going to be changed or repealed. The second reason is because the opportunity cost of 6.5 years of mandated Dodd-Frank rulemaking meant that we had a lot of things that we needed to get back to our core mission. Our core mission at the SEC is 3 parts: protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. And it's really that third part of our mission that was really suffering. We had a brief respite with the Jobs Act that Congress passed, and we did some Jobs Act mandates. But we still need to do more there. We need to do more to help small businesses that are private get access to capital through exempt offerings, but also potentially have them tapping the private market, the public capital markets. And if you go back 20 years ago, as one of the Treasury reports points out, we had twice as many public companies as we do today. That's fine if you're a private company in Silicon Valley or Boston and New York. But if you're a private company in any other places in the United States, you have difficulty accessing capital. And also, Main Street investors find it very, very difficult to invest in growing companies. The companies that are going through their growth stage right now are doing it in the private markets and not in the public capital markets. So one of the things we want to try to do is focus on how can we facilitate capital formation in the private markets, get more Main Street investors involved in that, but then also make it easier for companies to go public, and so that investors can access those things. And we have a roadmap. We have a couple roadmaps to figure out what exactly we want to do. So first is one of the Treasury reports that Craig mentioned, the Treasury report on capital markets and capital formation. They have a number of recommendations in there for us in terms of things that we can do. The other roadmap is some of these bills that Chairman Hensarling has been able to pass the House on a bipartisan basis. And then what I've been doing is going out and talking to people and saying, all right, of all of those different things that are put forward, if we only have a small window of time, what are like the top 2, 3, 4 things that you'd like to get done? I've gone around, I've gone to places, not only Silicon Valley, New York City, but gone to places like Pittsburgh, Cincinnati, Austin, Texas, Ames, Iowa, and talked to people. And 3 things have sort of risen to the top of the list that I keep hearing from folks. One of them is expand the ability to use an exempt offering called Regulation A offerings. These were traditionally limited to $5 million offerings in a 12-month period. Congress in the Jobs Act told us to up that to $50 million, but more importantly told us to consider periodically whether we want to up those offering limits. And the Treasury report and additional bills by Congress have suggested that we raise that limit to $75 million. This is an exempt offering that Main Street investors, not just accredited investors, can participate in. So I personally think this is a potential way for us to get back, so almost like a mini IPO market, and get some of these smaller offerings out there for retail investors. The second one is mandatory arbitration. We're seeing fewer public companies in the United States, not only because private companies are staying private longer, but fewer foreign companies are choosing to list in the United States. It used to be we were the listing venue of choice throughout the world. We had the best regulation, the best laws, the best accounting standards. And people viewed the cost of going those was worth the benefits of access to the public capital markets. But over time, what's happened is those costs have risen and risen to the point where foreign issuers are now avoiding the U.S. capital markets. And one of the big reasons for that is security class action lawsuits. Foreign companies fare particularly badly in U.S. courts on these things, and so one of the things I've been saying to people is, come talk to us. The legality of it is clear. Companies can put them in their charter. They can put them in their bylaws. Politically, it's a very difficult environment right now on that, but companies can do that. And then the final piece that I'll mention is Sarbanes-Oxley 404B. This is one that perennially comes up. Why do we have fewer public companies, or why aren't companies going public until they're later in the stage? And it's the fixed cost of Sarbanes-Oxley 404B compliance. And it's not just the cost for companies that are complying with it right now, but it's the foregone opportunities of companies that aren't going public. One mechanism we can use is something called the smaller reporting company, which exempts them from certain public companies. If you're under a size of $75 million in float, you're exempt from 404B and some other registration requirements. And if we could up that limit, Congress has suggested $250 million. I believe the Treasury report has also suggested $250 million. And so now we can have companies that can opt out of this excess compliance burden and potentially open up more opportunities for companies to go public. Plenty more things for us to work on, but the key point is we only have a small window of opportunity to get these things done. So we need to figure out what are the low-hanging fruit, what are the most biggest bang for our buck, and time is of the essence, and we just need to get these done.
Why do you say that you have such a small window of opportunity? What is the...
Historically, we've seen that, right? So if you think back to the early 2000s, during the dot-com bubble, or whatever you want to call it, there was a number of things that Chairman Harvey Pitt, when he came in, wanted to do to increase access to the capital markets. And then we had September 11th, we had the Enron scandals, and then we had Sarbanes-Oxley. And then with the Sarbanes-Oxley mandate, that kept the SEC busy, took us away from our core mission for several years. Just getting out from under that, Chairman Chris Cox came in, started to move us back towards a capital formation agenda, and then of course the financial crisis happened, and then we've had 6.5 years of our Dodd-Frank mandate. So now the window of opportunity has opened again. We don't know what's going to come down the pipeline, whether it's changes in Congress, whether it's something external that comes in. We gotta put the pedal to the metal and try to get as much done as we can, as quick as we can.
Okay, that's a perfect segue to you, Ju Young, this idea of the pedal to the metal on deregulation in general. I'm interested in your views on, first, what's in 2155, the Senate banking bill. There is a general consensus that this is relatively reasonable reform. It had Senate Democrats in support of it, mainly focused on community banks, not a lot of relief for the largest banks. Talk about that in particular and how it impacts the ratings on these banks and the risks that these banks face. And more broadly, all you're hearing about efforts to deregulate in this space. How is that going to impact the banking industry, the safety and soundness of these banks that you follow?
Sure. So I'm taking a bit of a different perspective. As a rating agency, we generally try to take the perspective of creditors. And so from our perspective, a lot of this post-crisis regulation has actually been quite aligned with creditors' interests. So if you think about higher capital standards, higher liquidity standards, better governance, or rules requiring better governance, those are all things that help the credit profiles of banks. And in fact, I'd say right now we're looking at banks. They have probably the best capital levels, the best liquidity levels, very strong governance, the best we've probably seen in quite some time. And I think things like stress testing and, most importantly, resolution planning have really done a lot to improve the safety and soundness of the banking system, and I think has given the market a lot of confidence in banks. So there is a risk, I think, from our perspective in terms of deregulation, and there's been a lot of talk about, there's less credit availability, but our study has shown that actually loan growth post-crisis, if you look at the 2011 period on, has really outpaced GDP, and in some asset classes has been, multiples of GDP, and so very healthy growth. And the one factor that is sort of holding back loan growth in the post-crisis period has really been the fact that the housing sector, because of foreclosure, has taken a longer time to recover. So actually loan growth's been pretty good from our perspective. We look at earnings, which is the one thing I think where banks haven't fully recovered. That's partly been because of the low interest rate environment that we're in, as well as I think structurally regulation has probably taken something out of bank earning profiles. We've spent a lot of time looking at the Financial Choice Act. We've spent a lot of time looking at the Senate bill. Those are all things that we're paying a lot of attention to because I think you're right. From a big bank perspective, they're probably not going to get a lot of relief, and the smaller banks will. But we view that with some caution because I think if you look at, for example, like a 10% leverage ratio, which is a simple, I know that was part of the original Choice Act. When we did an analysis of all the banks that failed between 2007 and 2011, and it was quite a lot of bank failures at the time, these were mostly smaller institutions, 35% of them failed with a 10% leverage ratio. So you have to be careful to make sure that that's, you still have to look at risk-based measures, and I do think from a bank creditor's perspective, those prudential requirements are quite important. And so we are looking at that with some level of caution. I think we will acknowledge that regulation probably has had some unintended consequences a little bit differently than some of you may be thinking about. There's been talk about the liquidity in the bond markets changing because banks have not been, the broker-dealers, they've not had as much inventory. But I think from our perspective, we look at that and we say, there has been the risk that some bank management teams are over-relying on CCAR as opposed to doing their own. I mean, they're all doing their own stress tests too, and we actually think that's really important. But to the extent that they over-rely on regulator stress tests as opposed to their own, we also look at whether or not, these management teams are going to start dividending out a lot of capital. And at this time in the cycle where, asset quality's been at an all-time peak, The credit environment's very benign. And if you start to lower capital requirements, then I think the timing could be an issue.
Mm-hmm. Craig, I wonder what your thoughts are on what she just laid out, particularly the idea that we made these banks a lot safer with the stress tests and the increased capital levels, and obviously bank creditors like that. But generally speaking, there is a view now that the banking system is safer than it's ever been. Is there stuff in 2155 that should make people nervous about safety and soundness in the system, or is it correct that this is completely benign and we shouldn't worry about any of its impacts? And should we be monkeying around with stress tests that have worked very well?
Well, sure. I mean, what I think is fascinating as we did our work, and it was the extensive outreach to borrowers, consumers, advocates, industry, to understand how regulations impacted them. But completely independent of our work, there's been three really important judicial movements. One was the CLO decision to have risk retention for CLO issuers was deemed inappropriate in court, and that the sponsor was not an originator in the intent of that reg. The fiduciary rule was vacated in court, and all that work the Department of Labor had put into that as to overreaching their authority. And of course, the court had invalidated or reversed the designation of MetLife. So really completely independent of the administration, three different judicial bodies had really looked at this and said, well, this is either not properly tailored or it's inappropriately applying the statute. So I think what we're really trying to do is apply common sense to this. And one issue is the regulatory fragmentation. So there's a lot of overlap. So a lot of our ideas are just doing things once rather than multiple times. And the regulations that have multiple rule riders like Volcker, risk retention, other things fall victim to that. The Community Reinvestment Act's a statute which we've just put out a piece to modernize. There are three regulators there for institutions. Independently, they don't overlap, but there's a lot of inconsistency on that, and we think we can improve the investment in communities while also rationalizing the compliance burden. So I think the main gains of resolution planning, risk-based capital, liquidity requirements, and stress testing, we completely agree are important to retain. The bill does raise the threshold for CCAR tests, which we think makes a lot of sense. And we truly think that eliminating, working on the big things and eliminating some of the noise on the little things is really important, because with the overlapping regulations, you've had matters requiring attention in the dozens, and banks are tied up with launching new businesses, opening branches, et cetera. So I think it's really sense checking that, and the impact on regional community banks is particularly important.
Yeah.
Ben, I'd like to actually push back against something you said a few minutes ago. As someone who served 3 years under the Obama administration and now a year and a half under the current administration, I don't view the changeover, use the word deregulation, I don't view as if we've gone from a regulatory regime to a deregulatory regime. I wouldn't put it that way at all. I would say we're in the balancing phase. I think there was a time a few years ago when quality of regulation was confused with quantity. And there was just an enormous quantity, very little calibration of what the impact of all that quantity was. And I think what we're trying to focus on right now is really calibrating it to quality. In other words, does it really achieve the purpose? It seemed to be, for a time, as a markets regulator, the only question that was being asked was how much capital should be retained on bank balance sheets, without any question about how much capital needs to stay in markets to have healthy market activity. It was a one-way question. What we're searching for now is what's the right balance between capital on bank balance sheets and capital deployed in markets. You can solve for solvency risk at the expense of liquidity risk. And the same institutions are going to need that liquidity in the event of an unwind or a crisis. So we've got to get the balance right. And so I feel very much right now we're in the balancing phase, we're in the calibration phase. I really push back against notions of deregulation, or another phrase that drives me crazy is industry friendly. I don't view ourselves as industry friendly. We're markets intelligent. We're market focused. We're economy focused. We're not trying to favor one industry sector over another. We're trying to get the balance right for healthy growth. I don't think anybody was satisfied with 1.5% economic growth over the past decade. We're trying to get back to a healthy level of traditional American 3+% economic growth and yet keep the elements of systemic stability and systemic safety that we've achieved.
And so you buy the idea that, I'll let you go, and you might want to answer this as well, Mr. Chairman, that it was in fact this regulation that was limiting us to, I mean, obviously the tax code, and we've done tax reform.
A range of things, right?
Yeah,
A range of things.
but to what extent was it really financial regulation that was impeding faster economic growth? And maybe, Chairman, you want to address that.
Well, I think it was a huge component. And many of the market participants I speak to, many of whom can be found at this particular conference, believe that Dodd-Frank has taken at least 50 basis points off of GDP. I hear some estimates that are even greater. So believe it or not, I do not believe all of Dodd-Frank was bad. I think that you did need, that we were terribly undercapitalized going into the financial crisis with our major global banks, having roughly 3% capital ratio. That is at least doubled. So we have better capital, we have better liquidity. If you believe that that is the answer to financial stability, that could have been done in about 10 or 20 pages of legislation and regulation, but instead we're now up to roughly 35,000 pages of legislation and regulation from Dodd-Frank. So I think you can make the case that we had inadequate levels of capital. I don't think you can make the case they were insufficiently complex. And since Dodd-Frank was passed, what we have seen is not only almost a decade of roughly 55, 60% of our normal post-war growth, but we've actually seen the big banks get bigger and the small banks become fewer. And we know that it is more difficult for middle-income Americans to access a mortgage. We know that many credit-worthy borrowers are now having to pay over $500 more for a car loan. We know that credit card offerings are now 15% fewer, and many of them cost 200 basis points more. So again, the simple view of the Choice Act was, let's have a trade-off between more higher levels of capital and liquidity for less in complexity. Because at the end of the day, I am very much fearful that what we're seeing is increasingly not this particular group of regulators, but there's been a many-decade long movement, if you will, that we erode the rule of law and it is substituted for the discretion of regulators. And so if there's anything that our regulators need to concentrate on now is, as Mike pointed out, the SEC has to rediscover that one of their mandates has something to do with capital formation. This is a very, very good thing. But we need a very stringent cost-benefit analysis. We need to ensure that all market participants are given due process, that our regulators follow the Administrative Procedures Act, and that they mainly are here to enforce. It is Congress's business to actually make the law, the accountable branch of government. And so this is what I think that we have to have our regulators concentrate on: more tailoring, less complexity, a commitment to due process, and to ensure that they are actually there to be a prudential regulator and not become involved in corporate governance matters. And I'm very concerned, particularly when I see Federal Reserve personnel actually being in boardrooms and making decisions that should better be left to management. This is a very alarming trend. And so, again, I very much salute what has been done on tax reform, but it has to be matched with regulatory reform if we're really going to have another sustained period of 3% plus economic growth, which is what the nation needs.
Okay, I'm going to come back to this.
Can I follow up?
Go ahead, Mike. Yeah,
just
I want to push back on one thing there, but go ahead.
Yeah, so to the point about the cost of the regulation, one anecdote that some of us heard yesterday in a private session, Michael Corbett, the CEO of Citigroup, they have 210,000 employees worldwide. 30,000 of them are in compliance. Think about that. 1 in 7 employees in that bank, or the bank holding company, is involved in compliance. These are employees or money that could be spent to doing other productive activities like lending and doing what banks and bank holding companies do. The other point is, Chairman Hensarling brings up a very good point, doing cost-benefit analysis. One of the things that unfortunately was not done in Dodd-Frank was a cost-benefit analysis, or a realization that many of the provisions in Dodd-Frank are attempting to solve the same problem. So there's a lot of overlapping regulations, overlapping costs that can be taken out of the system. People have been using the phrase effective resilience. How can we take costs out of the system without decreasing the benefits of the regulation? To Chris's point, it's not about deregulation, it's just thinking about that, right? And one of the things that we are good at the SEC, we've gotten better at, is cost-benefit analysis on our rulemakings, where we can say, all right, well, the benefits of one way of doing this, justify the cost in this case, and the benefits are greater than the cost. But when you add more and more regulations, one of the things we're not good at, the regulatory agencies, is the fact that you have a lot of cumulative costs. Any of them individually you can justify, but you just keep adding layers and layers of costs in the system. There's an analogy that I like. There's an economist named Michael Mandel who uses the pebbles in the stream analogy, where if you think of a stream as the economy flowing, and if you throw a pebble into that stream, it's not going to upset the flow of that stream. But if you throw enough pebbles into that stream, you can restrict the entire flow of that stream. You can't look back and say, aha, it was any one particular pebble. It was the cumulative effect of all the pebbles. And so what we need to do as regulators is look back and say, all right, what are the biggest pebbles in that stream, and what can we try to do to try to open that up and get the economy flowing again and get access to capital flowing again?
Now, for some reason, I have the song Islands in the Stream in my head, so thank you very much. Ju-Young, what do you make of all this that you've just heard in terms of, we're in the rebalancing phase. We are trying to make sure that we don't have this giant pileup of pebbles blocking the flow of our economy, and that GDP growth has been shrunken and held back by this wave of Dodd-Frank regulation. Are you buying this?
So I'll say this. I think we can acknowledge, and I think even bank creditors can acknowledge, that there were elements of the rules that were not tailored for specific types of business models, right? So you look at the trust and custody banks as an example, and you're using certain risk-based capital rules for those institutions, which they're very liquid, right? And so then you're penalizing them for being very liquid by forcing them to hold extra amounts of capital against that liquidity. So those are areas where we think that, from a creditor's perspective, it might be more neutral if some of those changes were to go through. I think the Volcker story is one that's been talked about a lot, and from our perspective, as long as the spirit of the rule is maintained so that banks are not returning to proprietary trading, I think from our perspective, that's also not a negative from a credit perspective. And we do think that there's been a lot of money that's been spent on compliance, and we've heard from banks that some of their submissions are 10,000 pages long for one Volcker submission to prove that they're not proprietary trading. And so it seems to me like those are areas where, yeah, that's neutral to a credit profile and actually might help their earnings a little bit, which could be, and we are trying to balance the fact that at the end of the day, as bank creditors, your first line of defense is shareholders, right? And so shareholders do need to have some return. And there's this big question about, and that's the lagging bit, is the earnings story. And so if shareholders aren't getting some return, then are they going to be there in a crisis when banks need to raise capital and creditors need them to be there to raise capital, right? Mm-hmm. So there is a bit of a balancing act. But it's if there's too much capital return. And I do think that when we look at the rules, there is a swath of banks that have the opportunity now to return a lot of capital to their shareholders, which from a creditor's perspective is negative. But ultimately, I think the ratings impact will depend on how each individual bank responds to it and whether or not they go, full bore into returning capital, or if they maintain relatively conservative profile.
So you don't think if 2155 passes as is by the House and is signed by the President, that's not necessarily ratings negative for?
No, I think we have to wait and see how the banks respond to it. So I think different banks will respond in different ways. Some will be more conservative. And I do think, I think most bank management teams have acknowledged that stress testing has been a good discipline. And quite frankly, it's a sunk cost, right? They've already spent all that money. And it has, in many ways, improved the governance of the banks. And so maybe they don't need to do all of the work around it. But I think many would say that it's largely been positive.
And as important as debt creditors' perspective is, all of us here that have regulatory roles have to take a much broader view of all the diverse market participants in the marketplace and look at it not from any one industry sector, but look at it as market integrity as a whole, and are the markets functioning very broadly. So as important as that is, I think we want to take a broader view of what's been the overall impact of the rules as first implemented, and say, is there a way, as we now have, in the case of CFTC reforms, 4 years of data, 4 years of regulatory experience, 4 years of academic studies, 4 years of econometric issues, 4 years of market participant comments to say, did we get the first pass at this right? And are there ways we can either make it less complicated, more efficient, less burdensome, and still achieve the same objectives? And I would say that's been the change in approach, at least from my perspective of 3 years in one administration, now a year and a half in another. Okay. It's really about calibrating this for overall market efficiency and vibrancy, and not with great respect to one group of market participants.
Sure. So I have go ahead. I wanted to ask you one thing, though, and then you can say what you want to say, and that is the next chair of the House Financial Services Committee. Not going to be you, obviously, and there is some jockeying now going on for it. I think Mr. McHenry would sort of be in line for it unless he decides that there's another leadership job that he might like. Can you give us your assessment of who is likely to wield that very important gavel?
My, how the time has flown.
Yeah. You don't think you were getting away without answering this question?
Well, number one, there are 2 announced candidates that I am aware of. So it's Bill Huizenga from Michigan, Blaine Lukemeyer from Missouri. They're both on my leadership team. I picked them. They are my personal friends. So either one, I think, would be a great chairman. Obviously, if Patrick McHenry, I also chose him early on to be one of our subcommittee chairmen. He's a little busy now with his chief deputy whip gig. He would make an excellent chair as well. So notwithstanding the fact that I'm personally fond of her, anybody on the leadership team would do quite well. I don't think I would care for Maxine Waters to succeed me as chairman.
Was going to be my next question.
I saw her though, and again, on a personal level,
I was with you when you saw her.
Get along just fine. If I could, I did want to make a point about stress tests, because they are particularly expensive and burdensome. All the banks I know are constantly stress testing anyway. They're stress testing some group of assets, and the prudential regulators have access to these tests. So I'm not necessarily saying that we shouldn't have a prudential regulator imposed stress test, but I guess to some extent, what I find objectionable is not knowing what's in the test. And isn't the point of the rule of law actually knowing what the law is? And also, if we're going to have transparency, shouldn't the public writ large have some opportunity to opine on the various scenarios that are promulgated? I think this would be an improvement. And so, at least on the House Financial Services Committee, we're thinking that this should probably be at least an annual function as opposed to a semi-annual function. That we probably ought to have a base case and a worst case scenario. I'm not really sure why we need to go through the expense and trouble of that third scenario. But I also think that to a great extent, people ought to know what they're being tested on, and the public ought to know what the banks are being tested on as well. But this is a particularly burdensome regulation, again, when stress testing is taking place every day at banks already.
I occasionally showed up for tests in college and didn't know what I was getting tested on, so I don't know why the bank should have more advantage than
Perhaps you should have studied.
Yeah. Oh, I did very well on them. I just hadn't realized they were happening, and wound up doing just fine. Craig, I want to come back to you I want to pivot a little bit to FinTech and Bitcoin and blockchain technology, and there's a lot of anticipation for your report that will be coming out on these topics, and I think some expectation that it already would have come out and it got pushed back a couple of times. Can you, A, tell us when to expect it, and B, give us a bit of a preview for what's going to be in it? What kind of roadmap are you looking to give people for the regulation in this space that is just exploding and is bifurcated in its regulation? We can get into some of that too. When do we expect it? What's it going to say?
Well, first of all, part of this, we're talking about tailoring regulation. Part of this is we have to modernize regulation. So topics like cryptocurrency and cyber risk are forward-looking challenges, and the next crisis will be different than the prior crises. So I think a lot of all this regulatory changes have to revisit what's happening in the current environment. That will profoundly come to roost in this new report. I think the genesis of the report was the first three reports dealt with what would call the defined regulated sectors. And as we did that, we found there was an enormous amount of business that had moved out of the regulated sector, notably. We don't like the word shadow banking because most of it's not really banking, and shadow suggests there's no regulation. Certain parts of that have high degree of regulation, but there was a lot of movement. And then the other thing we noticed is there seemed to be a much higher rate of innovation outside the regulated entities. Call it FinTech, RegTech, other elements, which just seemed unhealthy. Why shouldn't the existing companies be innovating? And is that caused by regulation, legacy, investments, and other factors? The importance of this is that innovation is critical to U.S. competitiveness. China, other countries are creating new things all the time. We have to innovate. Innovation also in FinTech delivery increases access to credit, but more importantly, the cost of credit. The one thing when you talked about loan growth, which has been sound, is the cost of credit's much higher because of the burden of regulation, what it costs to process a mortgage loan, for instance. So all these innovations, and there's three large areas. One is payments, the other is lending, and the other is security settlements and sort of markets. So those are the three big groups. We'll probe federal versus state regulation and the implications. There's was the beginning of an OCC charter that hasn't been implemented. There's an FDIC charter that allows you to take deposits. Many of these institutions in FinTech don't really want to be banks or take deposits, but they provide bank-like services. So I think the highlight will be defining a federal versus state environment and thinking about the implications, encouraging innovation in regulated sectors, and obviously going back over the nature of why you have regulations and applying it to these important changes. It's going to, I think, in terms of delay, there wasn't really any particular delay. We, had the orderly liquidation report out, and then this actually ended up being incredibly fragmented. You might be surprised that most of these companies don't even have a government relations office in Washington. So if you want to talk to them, you have to go into the field. You have to really understand their business models. We are going to talk about technology and blockchain and some of the other building blocks, which were new ground. So it's been a great exercise to do the research, but less organized and required a lot of work in the field.
Yeah. Chris, I think this gives you an opportunity to tell these people your crypto dad story and how you became known as a crypto dad.
So it's really remarkable. Who would have thought that a Senate testimony broadcast on C-SPAN would have led to 49,000 Twitter followers? But I, along with Mike's colleague Jay Clayton, I testified in front of the Senate Banking Committee on February 6th, and I had prepared a 45-page, 160-footnote written testimony, and I was going through it the night before, and I was thinking, oh my God, this is as dry as dust, and I've got to go in front of this banking committee tomorrow. So I actually put it aside, and when I got in front of the committee, I said, Senators, I've submitted a long written statement, but if you don't mind, I'd like to speak to you just extemporaneously, and I'd like to speak to you for a moment, not as the chairman of a regulatory agency, but as a dad. I said, I've got 3 college-age kids. I said, when they were in high school, we opened up small brokerage accounts for them. We hoped they might trade a stock or two and learn about the stock market. Well, no interest whatsoever. But something's changed in the last few months, and that something is Bitcoin. I said, suddenly all my kids want to talk about is Bitcoin. And I said I was away for our family ski trip, and all I heard about from them and their cousins and my nieces and nephews was Bitcoin. And it struck me, and this was my point I made to the Senate, that I think we need to take a moment and respect this generational interest in this new instrument, not with derision, but with a little bit of attention and respect, and respond with policy initiatives that really are thoughtful and forward-looking. Well, my Twitter account exploded. As it was happening, it was ringing behind me, and my assistant had to turn it off, and by the end of the week, I had over 40,000 Twitter followers at 6 Expanded. And I've been teased in the media, as, but believe me, I was not encouraging this. It just happened from a congressional testimony. I mean, who would have thought it? Yeah. But what people reacted to there is something going on here that's generational. I think that just as the baby boomer generation lost faith in the leaders that came before them and tried to seek a cultural change in those days through sex, drugs, and rock and roll, but I think there's a generation here that also has lost faith in us that led them through the financial crisis, and they see technology as a way of disintermediating institutions for which they don't have a great deal of respect. And I think there is something here that is worthy of greater attention. And it's really just aside from what we're grappling with is how do our old rule frameworks deal with this new application. Our rules were written in the 1930s, as were the SEC's, and really couldn't contemplate anything like this. And we are struggling to find out how we apply an old law to really new and very different applications.
Yeah. Mike, why don't you talk a little bit about the SEC's role here in the cryptocurrency space, and particularly initial coin offerings, which there seem to be every day a new slate of them, and ridiculous concepts for cryptocurrencies that get a lot of people excited and interested. And the reason you got 40,000 new Twitter followers is that there are on Twitter these zealots who are pumping anything Bitcoin related, anything cryptocurrency related, whether it's legit or illegit.
Oh, you're betraying your bias there, though, because that's the bias, that all of them are...
I'm not saying all of them are bad,
but the point
there are lots of them
But the point has been, there's a lot of really altruistic interest. There's
I'm
people
sure there are.
that believe this will support the unbanked,
Yes.
that this is a new age, and that's the point.
Yeah.
I was where you were. I thought this was all just nonsense.
I
but
don't
the
think
fact
it's
of the
all
matter
nonsense.
is, there is a lot of true believers.
No, that's true. But
I think he called you a Bitcoin Neanderthal.
Yeah. Well, I did a whole podcast on this, and when I expressed any kind of skepticism on the long-term prospects for Bitcoin, people said unkind things to me on Twitter. But ICOs, there are a lot of them. What's the SEC doing to regulate them?
Yeah, exactly. So so this Bitcoins was sort of the first iteration of this, right? And are they a commodity or are they a security, right? We've not yet determined that any of the crypto assets are in fact a security, but our general counsel's office are continuing to look at this because there's all kinds of new Bitcoin type crypto assets coming out there. Initial coin offerings are different, right? And on the one hand, it's potentially a really cool way to disintermediate, to democratize capital, and to think about things like using smart contracts to come up with, to get financing, to access to capital for companies, mostly to an entrepreneur that have a business plan and get this thing going. Our first look at this is, well, is an ICO a security? And so far, as our chairman has said, everyone that he's looked at and everyone I've seen is a security, right? And how do we determine that? Well, last year we put out something called a 21A report. People refer to it as the Dow report. It was a report of investigation involving something called the Distributed Autonomous Organization, an ICO that actually got hacked and it never really got off the ground. But we put out there, this is the way we are thinking about whether or not it's a security. And it turns out what we're using is something called the good old Howey test, which was designed in 1946 to look at leasebacks arrangements in orange groves. And it turns out that as of right now, it's still a very flexible, useful framework for us to determine, is an ICO a security? And there's 4 prongs on that, and you can look at this report to see how we're thinking about it. If it is a security, then it falls into 3 buckets, right? The type of securities offerings. The first is the registered public offering. So this is the normal sort of IPO public offering companies, right? We've not had anybody register a public offering for an ICO. The next bucket is exempt offerings. So if you have an ICO, you have to fit into one of those types of exempt. If it's really small, you can use regulation crowdfunding, you can use regulation A, you can use Reg D, you can use those other types of ones. And the third bucket is illegal. And if you're not falling into the first 2 buckets, we've said we're coming after you. And we've started bringing some enforcement cases where people have not either registered with us or do not fall within the exempt offering status. And we're continuing to have conversations with people. To Chris's point, we could not have contemplated this. The Howey test works quite well, determining whether this thing is a security, but do the existing securities laws fit this? So far they have, but we're open to the point of, We need to have conversations with people.
Yeah.
There's a lot of conversations going on, the difference between security tokens and utility tokens. Can you have something that is a security morph into something that is not a security?
Well,
If you ever want to
isn't that
see,
what Bitcoin did? I mean, Bitcoin became a security. It was initially intended to be a means of transacting business, and now nobody would use it for that purpose because it's increased in value by
well, so if you run through the Howey test, we have not determined that it is a security. In fact, it probably fits better as a commodity, and Chris can speak to that. In fact, they decided to list futures on the Bitcoin in order to get greater insight into that. But there are other assets. It's all facts and circumstances. We need to run this through. Bitcoin itself is not a security, but these customized tokens for these initial coin offerings, most of them are. There's some legitimate stuff that's going on, and then there's literally the fraud ones that are out there. There's literally one called Ponzi coin, where the white paper says this is a Ponzi scheme and describes if I ever go back to teaching, I want to use this to teach what a Ponzi scheme is because it fully discloses what it
If I could jump in real quickly, in terms of the Treasury, I'd say the Secretary has enumerated that one of our concerns, regardless of the intrinsic investment value, is the role of this in illicit activities.
Yeah. Sure.
So as we've gotten into tightening sanctions and money laundering movement and terrorist financing, this is all a kind of a contravention of that because you can move value around in a non-traditional way, not using traditional mechanisms. So we just have that on the list also to think about. That makes it a bit different than other security investments, commodities in that way. And it's, I'd say, a significant concern where the G20 and IOSCO and others have started to realize that whatever we think about it as an asset class, so we can call it that ability of moving value around in illicit activities. It's turning up at most crime scenes, so it's a factor, but it also currently does not fit the grid for normal money movements around the world, and it's something we're working at.
So, Chris, the only ones that I have a bias against are things like Ponzi coin and things that fall in the illegal bucket. The other ones I'm skeptical of. But we only have like 30 seconds left, and I have a zillion more questions for all of you, and I apologize, our time is running out. But I do want your views on security versus commodity and what these things are.
Yeah, so what's interesting is we all come at this from a slightly different way because we have different statutes, different approaches. The CFTC, we oversee commodities. We're very cognizant of the Howey test for ICOs. Bitcoin came about in a different way and not through an ICO, and it fits our definition of commodity. That was actually a position taken by my predecessor, Tim Massid, and we followed through on that. We've been equally as vigilant on illegality and enforcement action as has the SEC from our own perspective. But what's really interesting is despite the different perspectives, and Craig at Treasury and Mike, the coordination amongst the agencies has been extraordinary. And I credit the Treasury Secretary and his ad hoc crypto team, but also the willingness of all of us to work together so we coordinate. So we in the SEC have been very coordinated on a number of enforcement matters, on looking at the definitions and not stepping on each other's toes, and it's working out very well. And again, the Treasury's played a key role in that, but as has FinCEN, has had the other regulators as well.
Yeah, I would just close on the note that my kid's 9-year-old's baseball team is called the ad hoc crypto team. So a very well named. I want to thank Chris, Chairman Hensarling, Ju Young, Craig, and Mike for a great panel. Thank you all for coming, and we'll see you later.